We saw that bit of a blip yesterday, but the markets have been riding a bit of a rally over the last few weeks. How much of that is on the confidence in the market that the Fed's done raising rates?
You know, a couple of things. I mean, we saw the Fed minutes last night. Nothing new there. Proceed carefully, the totality of the data. But I think what's important, Frank, is the Fed has made it pretty clear that their confidence about getting to that 2% inflation target will increase if three things happen. If growth in the United States moderate from that torrid pace in the third quarter, 4.9%, if the labor market begins to cool, and if inflation continues to move decisively lower. And I'd say, Frank, we've had good news on all three of those over the last 3 weeks. That's what explains what's been going on in the markets, obviously responding to that better news, that Fed checklist beginning to move in the right direction. So, we do think the Fed is done here unless inflation or growth accelerate again. We don't see it. We do think the Fed's done, and I think the mantra may be higher for maybe not so much longer.
All right, so it sounds like you think the fourth quarter GDP number, when it comes out, is going to have a lot of impact on the Fed and also possibly the markets. I want to talk to you about something else having a big impact on the markets, the Magnificent Seven. We're talking stocks like Google and, of course, Nvidia, which reported earnings yesterday. Those earnings, the company, I should say, under a bit of pressure, but it was really on soft guidance. It wasn't because anything fundamentally is wrong with their business. How do you think this report and the response that we're seeing, how does that shape your view of mega-cap tech?
Oh, goodness gracious, Frank. That was a blowout report, right? It came in at $18 billion versus $16 expected, over 200% increase. And look, there's some concerns around guidance in the fourth quarter, which is why the stock came off a bit. But let's just remember, there's $1 trillion invested in data centers around the world, and they all need some upgrading of GPUs. And as far as I can see it, Nvidia is in pole position. So, look, some softness on Chinese exports, but that was a very, very good number last night. And we continue to think, which is why we're passively exposed in the United States, you can't write off the Magnificent Seven. Having said that, we do think the other parts of the market, which trade at 14 times earnings, the other 493, represent some pretty decent value.
Yeah, a lot of people talking about those other 493 and the valuation there. Something else I want to talk about, the bond market. So you're forecasting a mild recession next year, and you say investors should lock in longer-term bonds. You're actually looking at the 10-year with a yield right now of 4.4%. So give us a sense. Why would I do 4.4% when I can go to the 2-year and get that 4.9%? Why do I want to lock in that longer duration right now?
So, good question. First of all, we think there will be a softest landing, not a mild recession. But, hey, it's all a bit nuanced here, and no one knows for sure. But I would say with respect to bond yields, if you can lock in, and we've been lengthening duration here close to 5% for 7 to 10 years, that's pretty good, Frank. Because remember, if the Fed cuts interest rates next year, which is what we expect, there's going to be reinvestment risk at the short end. And that, sort of $5.7 trillion parked in money market funds is got to go somewhere if they're going to be facing lower interest rates. So we think the lengthened duration, we want to get ahead of that. But we also think, if the Fed is successful in bringing down inflation, it could also be good for equity markets as well.